Hi everyone, it's S Piatek, Vice President at the Federal Savings Bank. Today we're going to be talking about the VA home loan closing costs and the 1% origination fee as it relates to buying a home. Now it might not be the most exciting subject, but we need to go over it. Closing costs consist of and the 1% origination fee. It's probably one of the most confusing aspects of the loan because it changes throughout the loan transaction and you're trying to figure out exactly how much this is going to cost. These fees will initially appear on the loan estimate, meaning the lender is estimating these fees, and later it turns into a closing disclosure, meaning the fees are finalized. Closing costs are broken down into 6 sections: origination charges, services borrower did not shop for, services borrower did shop for, taxes and other government fees, prepaids, initial escrow payment at closing. Origination charges can be broken down into 2 categories: origination fee and percent of loan amount points. The VA allows the lender to charge a 1% origination fee, meaning if you're buying a home for $400,000, they can charge you up to $4,000. Be careful, many large veteran-focused banks charge that amount. At the Federal Savings Bank, we charge a flat fee of $13.38. That fee can also be reduced to $0, depending on how we structure the loan. That alone will save you thousands of dollars. Remember, just because it's allowed doesn't mean you should be paying that much. This is where a lender will charge you an extra fee to lower your interest rate. Be careful, it doesn't always make sense. You be the judge. Same example as above. If you're buying a home for $400,000 and don't want to put any money down, and the fee to lower your interest rate costs 1%, that would be another $4,000 on top of the origination fee. So let's say the going interest rate is 4.5% with no discount points. The payment would be $2,026.74. If you pay the 1% discount point, it lowers it to 4.375. Now remember, to reduce the interest rate to 4.375, you just paid $4,000. Now let's divide that cost by the amount that you would have saved, which is $4,000 divided by $29.60 equals just over $135. That's how many months it would take to recoup that money. 135 months is a little over 11 years that it would cost to recover that money. Always be sure to work with a trained mortgage banker to understand if this is the best option for you. One very important thing to know about these fees: once they've been disclosed to you, they cannot increase without a valid change in circumstance, but they can always decrease. Services borrower did not shop for. These are a couple fees that consist of third-party fees that you cannot shop for. Number 1, the appraisal fee. The appraisal fee can and will depend on the appraiser and the type of property you're buying. A single-family home is going to be cheaper than a 2 to 4 unit appraisal. Once the appraisal is completed and the invoice has been obtained, then the true costs will be reflected. As long as there are no changes in the type of property from what is initially disclosed, the cost originally disclosed is all you will have to pay. Number 2, credit report fee. This fee is the lender's cost to check your credit. Number 3, a flood certificate. The flood certificate determines if your property is located in a flood zone. If it's not, nothing else is required. If it is, then you will have to get a flood insurance policy. Number 4, other fees that can appear in this section. Reinspection fee. This is where the appraiser would have to go back out to the property for a fee to clear the appraisal. Disaster cert. In the event that a natural disaster happens in the county you are buying a home, the lender would require the appraiser to go back out to the property and ensure that the home was not damaged. Number 5, VA funding fee. This is the fee that the VA charges for using your VA home loan. It's not a fee that the lender keeps, and this fee is typically rolled into your mortgage. That's why you normally see the loan amount higher than the purchase price. If you collect a service-related disability, this fee is waived. We'll be going more in-depth about the funding fee in a later video. Services borrower did shop for. This fee is normally for the title report and title insurance. This fee depends on the state and is either chosen by you or the seller's attorney. Title insurance protects the lender of any claims against the property. For example, if the seller has some work done on the property, a new roof, prior to you taking ownership, and they never paid the bill and a mechanic's lien was placed on the property for $25,000, title insurance will cover that. The fee ranges widely and lenders estimate this cost in the initial loan estimate. You typically find out the actual title fees about a week or two into your purchase. Taxes and other government fees. This section is also heavily driven by the city and county you are purchasing in. Some cities, counties, states will charge you a tax for buying or selling a home. The easiest thing to do is ask your lender or realtor what taxes you're responsible for. Another fee that can be incurred is called a recording fee. That's a fee that is passed on to you to record the mortgage with the county. Prepaids. Prepaids are fees that are due at closing. These fees are necessary to create an escrow account or to adjust seller's escrow account. This section is normally broken down into 4 subsections. 1. Homeowner's insurance. Homeowner's insurance is paid 1 year in advance. Now, in your monthly mortgage payment, you will have a built-in homeowners association due in your mortgage payment that will be set aside into an escrow account, which is required on a VA home loan. When the next year, same time, comes around, the mortgage company will make the next year's payment on your behalf. Number 2, mortgage insurance premium. The mortgage insurance premium, although it wouldn't be listed on the VA home loan, is customary with loans that have mortgage insurance. Number 3, prepaid interest. Prepaid interest is the charge due at closing for any daily interest that accrues on your loan between the date you close on your mortgage and the period covered by your first mortgage payment. For example, when you rent an apartment, you make your payment on April 1st. You're paying rent from April 1st through April 30th. You're paying in advance. Now, if you're paying your April 1st mortgage payment, you'd be paying March 1st through the 31st. You're paying in arrears. So if your closing date is on the 15th and you have 15 days left in the month, then you will be charged 15 days of interest. The bonus, you don't pay a mortgage payment the month following your closing. For example, if you close on your home on January 15th, your first mortgage payment would be March 1st. If you closed on your home June 1st, your first mortgage payment would be August 1st. Number 4, property taxes. This section will indicate the total amount of taxes due either during the month of your closing or before your first mortgage payment is due. For example, let's say you're closing on your home March 2nd and the first 6 months of taxes are due in March. The title company and or lender may require you to prepay all 6 months if the tax bill hasn't been already paid. This can have a drastic effect on your closing costs. Escrow accounts. Escrow accounts consist of a reserve account that collects money up front to set up an account that'll pay your property taxes, homeowner's insurance, and mortgage insurance if it's required. A majority of the time, the lender requires a 2-month cushion just in case your taxes go up and the lender needs to cover them. Now, the escrow account will normally consist of more than 2 months, depending on when you close. Don't forget that you don't have a mortgage payment the following month of closing, so there will be an additional month factored in. That wraps it up. Now, we covered a lot of information, but don't worry. I'm happy to walk you through the process. Give me a call and apply today.